It's time for an update on the VIX, the volatility index of the S&P 500. We've seen a notable move once again in the equities, on the equity side to fresh all-time highs after the Fed. And what it has also sparked at the same time, as you can see on the chart here, is the VIX essentially getting back into the low 12s. And so what I'm about to go through here and say may seem a little bit obvious to some people that are active VIX watchers, but I've also noticed quite a few people having this discussion of late, and I see some of the fallacies of logic here. So lots of people are used to look at this market now through the lens of breakouts and breakdowns. The VIX is a mean reverting. Volatility is a mean reverting asset. So when you draw lines like this is not a breakdown line where the VIX is going to collapse to 5. It won't do that. It may go down to 8 or I mean, absolute worst case lowest is something like in the 9s, which is very difficult to imagine from here. So we can't look at this as an asset as such. It's a mean reversion asset. Basically what that means, if you get to the lower end of the range like right now, the path of least resistance is probably higher, not lower. So long story short, the way we're looking at this right now is with equities at all-time highs, the VIX back at the low end of the range. It's not time to short the VIX. If anything, it's time to be doing something alongside. I personally don't trade the VIX in full disclosure, but it means that basically options have gotten very cheap again on the S&P 500 puts, for example. So if anything, it's a time to maybe buy a little bit of protection and cheap puts and not try to short the VIX. So it would be a buy the VIX kind of idea. But again, I like to do that, typically buying puts because they're cheaper now in the S&P 500. And this is also, I think, really interesting in terms of the dynamics of this. That what this year is probably going to bring us from here on forward is as volatility gyrates, it's going to give us, I think, much better opportunities to do something called an options credit spread, where we can generate income and also be directionally exposed if we want to be. I'm going to show you exactly how that strategy works, how we deploy it for our clients, how I do it myself. And we're going to hold a special session this week to educate everyone on that if you're interested in options credit spreads, which again is also going to take advantage of higher and lower implied volatility for income. We would love to see you in that discussion this week. We'll see you there.